Today, we examine the FAO Food Outlook because global food commodity markets are tilting under rising geopolitical and weather risks, and the implications span farmers, traders, and consumers. A single drought or shipping disruption can ripple through futures, groceries, and government budgets. The report highlights how cereals, oils, and meat prices have become more volatile since 2022, even as demand remains stubbornly inelastic. Geopolitics around major exporters, sanctions, and war zones threaten supply lines, while weather extremes strain harvests from Brazil to the Horn of Africa. Understanding these forces helps investors gauge risk and opportunity across asset classes. The moment demands disciplined, evidence-based analysis. FAO Food Outlook synthesizes signals from weather, trade, and policy to describe a tightening in global food markets. Imagine a global pantry where wheat, corn, and edible oils are the staples. When a drought or port closure reduces a key shelf, prices swing across the store. The current trend combines tighter supplies with growing demand from population growth and biofuel mandates, producing higher volatility than the last decade. Geopolitical frictions limit exports, while transport costs and storage challenges complicate trade flows. In short, markets are navigating a chessboard of weather, policy, and risk without a fixed equilibrium for investors everywhere. Background here traces the long arc from post-war food security programs to today's market integration. After the 2007-2008 food crisis, governments built buffer stocks and export restrictions that left a lasting memory of price spikes. Global trade liberalization accelerated, with a handful of crops orchestrating price signals across continents. The 2010s saw record harvests, moderating volatility, yet climate variability and public policies kept sensitivity high. The FAO, World Bank, and IMF began stressing resilience, while supply chains grew interdependent through regional trade blocs. The Ukraine conflict then jolted perception, reminding investors that physical assets can move markets faster than forecasts. Current market impact shows prices responding to uncertainty rather than certainty. The FAO Outlook notes cereals and sugar have traded at elevated levels, while oilseed markets swing on weather forecasts and export restrictions. In practice, traders watch the Black Sea corridor, Brazilian harvest updates, and U.S. planting data as price catalysts. Consumers see higher grocery bills, while food manufacturers face input cost pressures that squeeze margins. Retail commodities, ETFs, rise on inflation hedges, and large farmers adjust planting plans to hedge risk. Banks tighten credit for riskier bets, pushing risk premia higher in commodity-linked finance. Volatility remains the norm, as shocks propagate through supply chains. Who is affected ranges from farmers to fund managers and from processors to retailers. Major grain exporters like Russia and Ukraine influence global supplies, while fertilizer firms feel input price swings from natural gas and potash markets. Consumer staples groups face margin pressure when feed costs rise, and airlines and manufacturers rely on stabilized fuel and packaging inputs. Pension funds and sovereign wealth funds diversify into agriculture and real assets as inflation hedges. Smallholders in East Africa depend on predictable rains, while emerging markets wrestle with currency moves and debt servicing in a higher rate environment. Tech platforms connect growers with buyers, compressing margins. Geopolitics and macro factors provide the framework shaping risk appetite. The Ukraine conflict remains a clearing price for grain and energy, while sanctions and shipping insurance react to evolving diplomacy. Ongoing tensions between major economies influence currency flows, trade routes, and commodity access, particularly for fertilizers and fuel. Global growth signals vary by region, with inflation stubborn in many economies, yet easing in others. Climate policy and biofuel mandates interact with supply chains, prompting governments to diversify suppliers and stockpile reserves. As central banks recalibrate, real yields and risk premiums determine who bears exposure to agricultural volatility. Smart money reveals shifting allocations. Sovereign wealth funds and large asset managers are diversifying into farmland, logistics, and commodity-linked bonds as inflation hedges with potential resale value. Some funds tilt toward fertilizer producers and grain storage operators, betting on supply tightness and price resilience. Retail investors gravitate to diversified energy and agriculture-focused ETFs, while risk parity funds rebalance exposure to volatility. Banks offer structured notes tied to crop prices, and insurers assess climate risk as a major driver of underwriting costs. Overall, the market rewards resilience and penalizes complacency in the face of uncertain weather and geopolitics. Momentum remains directional. Bear case risks remind us that mispricing can turn into violent repricing. A severe drought in the Southern Hemisphere or a breakdown in Black Sea trade could trigger a price spiral, creating inflationary pressure and policy tightening that hurts growth. Sudden policy shifts, such as export bans or subsidies, can lock in higher costs for food manufacturers and erode consumer confidence. A spike in energy prices compounds fertilizer costs, while debt distress in emerging markets reduces import capacity. Finally, climate extremes threaten not just harvests, but the infrastructure needed to move goods to markets. Investors should monitor weather models and policy signals closely. Stay disciplined. For retail investors, careful risk budgeting beats sensational headlines. Start with a diversified approach that blends commodity exposure with quality equity and fixed income to avoid single-sector shocks. Consider low-cost, broad commodity ETFs or thematic strategies in grains and energy, but watch for roll yield and liquidity. Use stop losses and position sizing to curb volatility, and rotate toward regions with favorable crop cycles and currency stability. Build a simple watch list: major producers, infrastructure plays, and storage solutions. Finally, learn the seasonal patterns that accompany harvest cycles, so decisions align with supply dynamics rather than emotion. Stay disciplined. Outlook remains cautiously constructive on inventories and resilience, yet risks shadow the baseline. If El Niño or La Niña returns with unusual intensity, we could see further volatility in prices across cereals, oils, and proteins. Supply chain resilience, farmer adaptation, and smarter logistics will shape the next leg of the cycle. Investors should favor diversification, quality producers, and sectors with pricing power in inflationary periods. Policymakers may test markets with targeted interventions to prevent panic, while ongoing data monitoring keeps risk management sharp. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.